Hey there, Wealth Press subscribers. Welcome to another midweek update. And today I'm with Lance Ippolito. Lance, welcome.
As soon as you introduce me, I go and I put on a freaking option trade. Like, I feel like the worst. Like, the second you introduce me, here I am buying calls. And
great start to the interview. What are you buying?
Geez, it's like, and I'm about to make a few $100 here in a second because I'm about to flip them. I literally just bought some Momo calls.
Momo?
There is no Tinder in China, so I think it's too much funny business. So there is Momo, or their alternative is Momo. So Momo is like, again, from what I hear, the Tinder of China.
How'd you find out about it? How'd you zero in on the action? Was it the volume of option activity that drew your attention?
It was, and also too, this morning they've been buying IQ, which is the Netflix of China, call options. The stock actually spiked about 30% yesterday, and they're buying WB, which is another China, I believe, internet name. But from a serious point of view, if you really think about, let's say, the work from home, date from home, I'm a single young guy. I used to go to the bar, ladies. Now I go to the bar, there's 20 bar seats and two people, 6 out of the 20 can take a seat. So, it's kind of hard to meet people, right?
Social distancing does have its downside, doesn't it?
Right. I can't go and say, hey, let's go dance or go have a drink at the bar because you got to be far away. And,
Right.
So what has taken popular is online dating. Yeah, there's no denying. People are joining Match.com, all the, Momo, the Momo.com. People are still want to talk and interact and have some kind of relationship, some kind of social interaction. So these online dating sites are getting more popular. I'm saw the rise of Tinder and now all the other ones and the younger crowd, and now Facebook's coming out with dating as well. So I like the space. Actually, it just happens to be that Momo is a name based out of China, and these Chinese stocks like Lumpkin Coffee, obviously they've seen some problems with the accounting and such. So I always am kind of skeptical of them. I know Muddy Waters, Citron, they've came out with shorts on IQ, on shorts on GSX. And to be honest, they've been getting their butt kicked. And I do think those guys and girls are really smart and have fantastic research. And I can't say really anything bad about them. It's just they're getting their butt kicked because these Chinese ADRs are short squeezing. So here's Momo, and it's online dating. I like it. China stocks are catching a bid. I'm not sure if there's news out if China-U.S. tensions, but it's a rotation into, and
there was
they're moving.
Yesterday where Mike Pompeo was going to meet a Chinese emissary somewhere on some island to discuss toning down the relation to the tensions. So I wonder if that's behind it. I recall reading something about that in CNN. Very cryptic headline that they were having a secret meeting at a secret location at a secret island offshore somewhere, but it was Pompeo and a high-level ranking Chinese government emissary. And so perhaps that is the sort of the catalyst for the buy side in the Chinese stocks right now.
There you go. I think you might have put the pieces to the puzzle together and solved the mystery. The market likes news like that, secret meetings, stuff, because Wall Street can get in and make those moves ahead of time. And by the mass audience hears about it, or the news is actually out there and mainstream pick it up, and they think, oh, all right, well, that's good. I'm going to go buy, China ADR stocks. Wall Street's already made a killing. In fact, those Momo calls, they bought them at 50 cents or $1.10 right now. Those calls are
Wow.
up over 100%. And
See, that's what I love about your trading style is that you zero in on the opportunity just based on technicals, and you don't even care about the fundamental drivers. You're just like reading the technical tea leaves, going in for a quick hit and run. Out you go. While we're talking, you make a few $100. That's like the beauty of option trading using technical analysis, right?
Yeah, to be honest with you, I wish it didn't move so fast. I can't complain, but from um, a volatility spike analysis, I mean, they move so quick. If you're not literally seconds in, those options are up. I mean, in 10 minutes, they're up over 100% in value. Like, that's just so quick that it's very difficult for retail to react on that. I'm getting data straight from the exchange. If I was doing like a normal platform or waiting for a news feed to tell me, I might not hear about this for, hours or let alone the next day or so. So
there's another interesting point you bring up. How important is it to be directly to the top of the food chain when it comes to data feeds and trading if you're going to trade options? Are you saying that it is unadvisable for a retail guy at home to try and trade options using, say, his bank's online trading platform's real-time quotation system because it's going through so many sort of routers?
Normally, no. Normally, names don't happen this quick. So I would say no. But I will say, if you really want to, try to get the best price possible, and if you are trading very short-term options, therefore front month or like weekly options, prices are moving quick. And I think that's a big why we're seeing that is attributed to the really lack of moves in like the S&P. I mean, people don't want to trade index funds anymore. So what they're doing is they're going after like individual stocks that can move, whether it be they're highly shorted stocks, whether there be, news stocks. And they're picking these select names. Like if this was Microsoft or Apple or Intel or AMD, these calls would not go up 100% in 10 minutes. There's no way. There's so much volume on these contracts. They trade hundreds of thousands of options a day. They're very widely traded. But when you have like these individual stocks that really don't have a huge history of option activity, or just normally don't trade millions and millions of shares a day, these institutional guys or these big players who are buying these calls can really jump the option price, because what the market makers do is they say, oh, wow, someone's buying 2,000 call options of this Momo. Let's jack up the implied volatility because we don't know what's going to happen. So therefore, retail is now paying a boatload of option premium because of the implied volatility. We saw that in names like Hertz and Chesapeake Energy and some of these names that have been hitting the headlines for, especially like the Robinhood crowd, that, and 6 months ago, you never saw this kind of volume in Hertz or Chesapeake Energy or DraftKings or some of these new stocks. But since they have that new wave of trading in them, you're seeing like these massive spikes in volume and these massive intraday moves in some of these stocks that we haven't seen ever.
So are you suggesting that retail is ruling the day and institutions are being sidelined? And secondarily, what does that imply for the algorithmic volume? Because that's usually the biggest volume on any given day.
Right. So we still, we're still going to have, if you look at like, we'll say Robinhood, they're still making up very minimal volume and the overall stock market. It's very minimal,
as a percentage of total volume.
Pardon me?
As a percentage of total volume.
Right, exactly. But if you look at the option volume, I was looking at some stats today. The number of 1 lots to 10 lots being traded is up like never seen amounts that we've ever seen before. Just going back into a year ago. So if you think about it, let's say an institution buys 1,000 contracts of an option. And they route it straight to, let's say, the CBOE. Okay, that's an institutional order. But if you have 100 people buying a 10 lot of options, which pretty much anyone can buy a 10 lot, and you get 100 people, now you're having that same $1,000 contracts, and it's all retail volume. We never saw that before. So I don't want to say that retail can retail is or like the institutions, but you are seeing for the first time, like I'll see 500 lots hit the tape, thinking, all right, well that's 75 grand worth of premium. It's a big bet, and really it's just some Wall Street Bets trader and his little, I don't want to say little, and his little group buying some options out there, and they're attributing for 500 contracts. So stuff like that I've never seen before up until really a few months ago. So it's a little bit harder to make out. If they're putting like 3 million of option premium, that's obviously that's a big player, that's a big fund. But you are seeing momentum flow in individual stocks, and you're also seeing the rise of option algos, what we call algo sweeps, where these firms are basically having algorithms to sweep the offer at any price, and they're quicker than me or you clicking the mouse, so to speak. I've actually met with some of these firms here in Florida as well.
So these guys are basically building algorithms based on quant models that are making sort of statistical analysis driven assumptions about the future of a trade, and therefore going back and taking the whole thing? Or is it more like somebody's there's an active human trader hitting an algo to say, go buy all these options at any cost faster than anybody can, all these calls at any cost faster than anybody else. Therefore, you just driven the price up in the front month or whatever the time frame is, right?
Yeah. So usually what they'll do is they'll go to the front month and they'll go to the most liquid options they can find. And then they find the options are undervalued to the stock price, meaning they're looking for a little bit of option arbitrage in there too. So to give you an example, if anyone was looking at the stock Mark yesterday, it's a very highly popular stock. I know around 1 p.m., actually about 1:15 p.m. Eastern time, they had news. This Mark stock, it's Remark Holdings. It's very popular. Wall Street loves it. The Barstool's cat out there likes it. And they had news right around 1:15 p.m. And the stock started moving. It went from, where are we at? We went from about 100,000 shares to about 5 million shares on a 5-minute candle. So obviously a big jump. And I started noticing Mark, June, 2.5 calls, hit the tape, like just like this. They're buying like 500, 500, 500, 500, 500, 500. And that's them showing up on my scanner, which is probably seconds after the order is executed. So they were buying these options from like, let's say the bid was 30, the ask was 40. They're buying like 39. They're paying 39 cents. Whatever the market makers will fill them, and they're buying as much as they can. Then the stock spikes up in value. These options, I think they traded up. I mean, just from an in the money point of view, they're already about 50 cents. And what happens is that option algo already buys all those orders. So by the time you or me try to buy that same contract, it went from 39 cents to 55 cents. There's no way physically we can go put the order, get filled as quick as they do. So then what they can do is go and start selling them to retail, and let's say 50 lots or 20 lots, sell at, let's say 50 cents, 60 cents, and they're making that huge percentage return, way more than let's say a 10% move in the stock price if they bought stock.
Well, Wow.
It's pretty remarkable.
Okay, so so how are the institutions sort of responding to this increase in retail trade?
That's a good point. Or a really good question, I should say. I think the market makers love it, right? Your firms like Citadel, Virtue Financial, Flow Algos, they're crushing it. And from like a Robinhood or TD, they're buying data from them, so they can trade off of them. But I do think from an institutional point of view, in terms of like actively trading, like stuff like this, I think you have a lot of funds that are just like, oh, what do we do? Like we're trying to make our return to beat the S&P, and they're having issues. I think one of the big what was it? One of the big pension funds out there is now using extra leverage to meet their 7% annual return goal. It's like they're now using leverage upon leverage just to get a 7% return. I think you have institutional players who are just like, I don't know what the heck to do in this market. We've seen that with Cooperman was on CNBC the other day. I love the guy. Buffett, selling airliners, just not adding, not doing really much of anything. I think the institutions just have no idea, and the coronavirus has scared them, and the market has bounced back, and they're just like, we have all this cash we never deployed, and now we have to buy the market basically at pre-coronavirus levels.
Right. So they were sitting on the sidelines thinking it was going lower, and then the government steps in and starts buying or announces they're going to start buying corporate bonds, and the market does a quick big head fake and bounce back, and they're stuck with all this cash. So like,
yeah, you had every hedge fund manager came in and said, we're gonna, in April, May, we're gonna retest the March lows. Then I'll look to, buy the market, or then I'll put capital to work. And what did the market do? It never waited. It went straight up. They're saying, all right, well, then I'll buy a pullback. They didn't get a pullback. Tech stocks rallied. And, they're kind of just like, well, shoot. And you want to play an ETF? Great. But it's really these individual stocks that are moving. And if you don't have exposure to them, like your Square, Amazon, AMD, NVIDIA's, Zoom, Datadog, some of these names like that, you're kind of just a sitting duck. To be honest.
Right. So what's a retail trader to do, Lance, in this market?
If you're a retail trader, you have so many options, no pun intended, right now. It's actually a really fun time because I feel like retail has the advantage. And you're having the Fed basically step in and say, hey, we're giving all this liquidity into the market. Bankrupt companies they were saving. And the names that are discounted, I personally don't want to go and buy stocks at 52-week highs. It's just not my style. But names that are discounted, you do have opportunity. Like airliners, cruise liners, some of these material stocks that really got beat down, that you do have opportunity if you time it right to catch a big move and a big short squeeze. And am I saying go and buy American Airlines and UAL right now? No. But historically, on down days, if you have taken a position and sold on big rips, done really well.
Right. All right. So, that's great. Let's leave it there for now, Lance. That's a great update, and we'll come back to you on Monday next week for the roundtable. Thanks very much for joining us today.
Thank you, James. It was a busy day, busy conversation, but that's just how some of the opens are and the life of a trader.
Entertaining as hell. Thank you so much.
Thanks, James.
Bye-bye.